Hi, this is Invest Bursa, and today I'm going to teach you what are the 8 types of stock investment return you should know about. For more information like this, visit investbursa.com. The first is what everyone knows about. It's what we call as simple return or holdings period of return. If you have starting amount of 10,000 and currently your portfolio has grown to 15,000, your holdings period of return is 50%. The pros of this is that it's easy to understand, and the disadvantages of it is that there's no time element in this type of calculation. Now, most of the time, do not be overjoyed when someone tells you you have a 50% of return, because you do not know the real return until you know what is the invested duration. Which brings us to second type of return, what we call as an average return. Now, average return is still easy to understand, but there's still no compounding effect in this kind of calculation. However, the advantages is that it takes into account the time element into it. For example, if you still have 10,000 in the initially and your current amount have grown to 15,000, we've known that you have earned 50%. But what if I tell you that your invested duration is actually 20 years? So your holdings period of return is 50%, but because of this, your average return, you have to divide it by what? By 20. When you divide it by 20, over the past 20 years, your annual return is only at 2.5%. Now, this is not very impressive, right? Now, the third type of return is annualized return. In this example, we assume that you invest an amount in the first year and there's no additional adding into your investment, and also there's no withdrawal for the entire duration of investment. For example, if you have 3 years of invested duration, the first year you earn 10%, second year -8%, and third year 6%. And if you have a starting capital of 10,000, this is how you calculate the annualized return. You can see that it takes into the effect of compounding, and the formula is slightly more sophisticated than what you might have known. So in this example, the annualized return is actually at 2.37%. It's compare this to what we call as what the layman would have done this. This is about 2.67. While it is very near, but over a longer duration, you will see that the difference is quite huge. So to verify this compounding effect, what you can do is to say that this is the average annualized return, which takes into the effect of compounding. You take this percentage and basically you just multiply this by 2.37% for 3 times over 10,000, and you will get the actual amount if you were to go along this path. The next one is what we call as still on annualized return, but for a period of less than 1 year, assuming no additional injection or withdrawal. For example, if your starting capital is 10,000 and after 3 months it has appreciated to 11,100, can I say that for 3 months you have earned actually about 11%? So how do you analyze this? So when you analyze this according to this formula, you are actually earning about 51.8% for that year. However, this is not the right way to represent this fact due to ethical reason. And why is that? Is that when presenting actual performance, analyzing exercise in this scenario is actually not a good practice, because firstly, it is just a forecast of how the remaining 9 months is going to perform. And secondly, in cases such as this, while it is very possible to earn 11% within a period of 3 months, most will argue that sustaining this kind of performance, 11% for every quarter, is highly unlikely, unless you're dealing with some scammy investment. Anyway, moving on to the fifth type of annualized return. The fifth type is what we call as annualized return with regular injection. What I mean by that is that if you have a starting capital of 10,000 in the first year, and for every subsequent year you actually add in 500 to your initial investment, and this goes on for the next 10 years, and in the end you have an amount of 25,000. So how do you actually calculate the annualized return in this case? So using a time value of money calculator, which you can Google on your own, you can see that the annualized return is actually 6.25%, as opposed to 5.63, which is really not the way as most people will calculate annualized return. Now moving on to the next type of return, still similar to annualized return for more than 1 year, but the only difference is if you have an irregular cash flow. And what I mean by that, irregular cash flow in. Now let's bump up the figures a bit. It's the fact that if you have a starting capital of 50,000, and this is your invested amount in the first year, and the duration of investment is 10 years, but starting from the 5th year onwards, you're actually getting some dividends, right? Dividends or some kind of payout per year of 1,000 for the 5th, 6th, 7th, 8th, 9th, and finally on the 10th year, this is what you are getting, 60,000 at the end of 10th year. So there's no easy way to calculate this kind of scenario except to use what we call as the internal rate of return, IRR calculator. Now with that, we have to actually use an Excel to calculate this. So I've tabulated this into a table such as this, and you can see that the internal rate of return using the IRR formula would be about 2.73. Now this IRR is actually most useful when you are being proposed an insurance savings plan, because in insurance savings plan we take into account the premium you pay, then there will be some dividend being paid back, and there's some maturity value. So if I were to just to tell you that for upfront capital of 50,000, and I tell you that for the 5th year onwards you are getting every year 1,000, and at the end of 10th year you are getting 60,000. So in total you will be getting like 65,000 over your initial capital of 50,000, which is quite impressive actually. But if you put that into an annualized perspective, it's actually not that impressive per year, because they're only at 2.73. And the thing is, you are better off to actually put this amount into a fixed deposit, which gives you 3% per year for the next 10 years, and it will still beat this amount of 65,000, because of a fixed deposit you are getting about 67,000. So just be very aware of this. So this is what we call as irregular cash flow in, for normally applicable for insurance savings plan. Now the 7th type of what we call as a return in stocks investment will be annualized return, more than 1 year, but we have to account for not only irregular cash flow in, but also irregular cash flow out. Now taking the same example, if I were to say that your initial capital is what your cash flow out, you have an additional injection adding into your initial investment in the 4th and 8th year of 10,000, but at the 5th year you have a dividend payout of 5,000, and the whole investment runs for a duration of 10 years, and at the end of the 10th year you have a cash out amount of 100,000. So again, if you were to use an internal rate of return calculator, it will look something like this. Yes, this will be your additional investment, and this will be a dividend payout that goes into your pocket. This will be the final cash out amount. So your internal rate of return in an annualized perspective would be about slightly more than 5%. And finally, the final type of stock investment return is what we call as a time-weighted rate of return. In short, is TWRR. It's normally used for portfolio benchmarking. What it means by that. Now, for example, if investor 1, it has a starting capital of $250,000 by January 1st, 2016. 9 months down the road, the portfolio have grown to 290,000, and on the same day he add in another 25,000 to the portfolio, and after 12 months, which is the end of the year, the portfolio value has decreased to 298. So how do you objectively measure the performance of this portfolio, or the fund manager that actually manage this portfolio? So with this, we have to break it into two parts. The first part is what we call as we measure the first part before the second capital injection takes place. And for part 1, you can see that the return is about 16%. Now for part 2, since the portfolio has decreased in accounted for the additional injection 25,000 into the portfolio, there will be a performance depreciation of 5.56%. Now, same, if you want to actually combine these two, this is the way to combine it, and you can see that your time-weighted rate of return is about 9.8%. Now, compared to investor number 2, you also start at the same time with the same amount. Okay, so everything being the same, besides, apart from one thing, 9 months down the road, instead of adding 25,000 to the portfolio, the investor number 2 actually withdraw 25,000 from the portfolio. So by end of the year, the portfolio value has decreased to this amount. So again, we break into part two parts, part 1 and part 2, and you will come to notice that for each part, the time-weighted rate of return is exactly the same. So in that sense, time-weighted rate of return is to account for any capital injection or withdrawal. You remove that variable into it so it can objectively measure the performance of the portfolio or the person managing this portfolio. So there you go. 8 types of stock investment return you should know about. So for more articles of more useful information like this, check out investbursa.com.